Stock market. Everybody wants to learn about stock market. Everybody is talking about stock market. Many of them are scared about stock market. Many of them want to invest in the stock market. But the disadvantage is many of them don't know about it. In this video, we will be exploring everything about stock market from scratch as simple as possible. So let's get started. First, let's go word by word. What is stock? What is a market? Stock is a tiny piece of company which you can buy and own as a general public. Let's say example for Apple, you can buy a tiny piece of Apple's share which you can hold for a moment. If Apple does really well, then the prices of stock you own goes up, the value of your stock goes up. If it does not go well, the value of your stock goes down. Then market. Stock market is a place where you buy and sell stocks of different companies. Basically, you buy and sell tiny pieces of company for money. So there are two types of stock market. Before understanding the two types, let's understand how companies sell their stocks to general public. Why does stock market exist? See, companies need money to grow, to build factories, hire people, create new products, etc. Instead of borrowing from banks, companies sell part of themselves, that is stocks, to investors. Investors give money to the companies to buy stocks. In return, investors hope to earn profits if the company grows. This is why stock market exists. So before we get into the types and how stock market works, let me understand you a simple history of stock market. The stock market started over 400 years ago in Amsterdam, Netherlands, around in the 1600s. The first stock exchange. Stock exchange is a place where you can buy and sell stocks. It's maybe assume it as a market. It was created, the first stock exchange was created to buy and sell shares of Dutch East India Company, which was operating there in Netherlands at that part of time. Over the time, other countries created their own stock markets like the New York Stock Exchange, Bombay Stock Exchange, then London Stock Exchange. So let's understand how stock market works. Before how stock market works, let's understand what is an IPO. IPO expands to initial public offering. When a company first time gets to public, that is, there are two types of company in general: a public limited company and a private limited company. In a private limited company, the stocks of the company is owned within the individuals of the company. But in a public limited company, persons like you and me can buy the stocks of the company. But it will be a very fractional share, which can be even negligible, but the value of the stock can go up and down. So initial public offering. When a company goes to public limited, when a private company first time goes as public limited company, they do something called as the initial public offering, where they offer stocks of their company for certain value to investors like us, to the retail investors, to the normal investors and general investors like us in stock exchange. There are lots of stock exchange as we discussed below. So let's take National Stock Exchange for example, which is a stock exchange in India. Zomato in 2021 offered an initial public offering in National Stock Exchange, if I'm not wrong. Either it's National Stock Exchange or Bombay Stock Exchange, you can check it by yourself, where it sold parts of its company, the tiny pieces of shares of its company, to general public like us with the price they set for each share. With that money, they developed new products, they developed new services within their app to give better services for us. With that, they made certain money, and with that money, they gave certain profits to us as shareholders. So that is how it works, and the profits they gave to us is called dividends. Dividends is the profit you make from a share. If the company gives to you as money, we call it a dividend. So this is IPO, this is dividend, and this is how a company comes to public. So there are two types of stock market. One is primary and the second one is secondary. What is the primary stock market? What is the secondary stock market? A primary stock market is where you buy and sell stocks of the companies directly from the company. Example, IPO. when there is an initial public offering, you buy the stocks directly from the company, so that you are not buying or selling from anyone else. You buy it directly from the company. The company is involved in primary stock market to buy and sell, whereas in secondary stock market you buy and sell from public. Yes, you buy and sell the stocks from the general public who own it. There are two types of secondary market in general. Here also it will apply. So in primary you have equity market as well, and in secondary you have equity market and derivative market. Two types. We will discuss in depth about these two soon. So let's understand what is the equity market. This is the one you see in movies like The Wolf of the Wall Street or the new movie called Lucky Bhaskar. Everything talks about equity market, where you buy and sell stocks of the company. Then what is derivative market? There are two types of derivative market. Derivatives. I will tell you what is derivatives later. First let's understand this. Options, futures. Okay, so what is derivatives? So derivatives represent a stock, but it is not definitely a stock. Let's say that you have a curd. It comes from milk. It is derived from milk, but it is not inherently a milk. It is a derived version of milk. Just like that, it is derived from stocks, but they are not exactly stocks. So let's understand what is options and what is futures in depth. So what is options? There are two types of options: call option, put option. I will make you understand this with a simple example. Let's say that you live in a town called you live in a town. Let's just keep it like that. And you see the demand of apple is increasing in your town. So what you do is that you go to the apple seller and say that your apple's price in your town is right now 50 rupees for one apple. You go to the apple seller and tell that at the end of this month I will buy two apples from you for 100 rupees, which is for current price, and you pay a premium called 20 rupees, say 20 rupees, and whatever happens, the seller should sell you the apple for 100 rupees, two apple for 100 rupees. Even if the apple prices goes up or down, he have to sell it to you for 100 rupees. And let's say at the end of the month the price of apple goes 70 rupees per apple, but you get the apple for 50 rupees. After buying the apple, two apples for 100 rupees, you sell that for 140 rupees and you made a profit of 40 rupees. This is basically called call option. And if you do the same for put option, in call you're calling it for the prices will go up, but in put option you will call it when the prices goes down, and the premium you pay before it is called the strike price. So sorry, it's called the premium. For how much you buy it at the end of the month is called strike price. And in futures you go and say to him that the same thing, and you no need to pay premium in futures, and you buy it. If it goes up, then it's a profit for you. If it goes down, then it's a loss for you. But in options you have a right but not the obligation. In futures you are obligated to buy or sell. That's one thing that to be noted. If what you predicted was wrong, then you no need to buy or sell in options. Your premium is just taken. Your maximum loss is your premium you paid. If it is a profit, then you can go and exercise. The process of buying it after the end of the month is called exercise. You can do without it also. In that case you will lose your premium, which is also a loss, but you lose only your premium. Whereas in futures, you have to buy or sell it, you are obligated it. It's these both work inside a contract, so you no need to worry about getting your money, you will get it. This is a very important point. In options you have right but not the obligation, whereas in futures you are obligated to buy or sell. And I want to give a disclaimer in this video. So according to SEBI, 9 in 10 traders lose money. So the probability of winning money in derivatives is very low. So if you're not an expert, please don't invest in derivatives. That's one thing I have to say. To conclude it, let me understand you the derivatives as simple as possible. In derivatives, you bet the stocks go up or down. It's literally gambling if you don't know what you're doing. So it's gambling with no knowledge. If you don't have a knowledge, it's completely a gambling. Please don't invest in derivatives if you're not an expert. And let's go for equity market. It's a famous, you would have known it. You buy the stock of a company. If it goes up, you sell it for a profit, and if it goes down, you hold it and wait till it goes to profit. That's basically equity market. I think I explained everything. So if you have any doubts, please leave it down in the comments. See you. Bye bye.